Now, what that represents in the 10% is we also value the value of shares in that. In other words, we get 10% of the company, and the investor gets 90% of the company. You guys with me? All right. From day one, somebody puts $10 million, we don't have any assets. What is that company worth right now? $10 million, right? It's worth $10 million because there's no other assets with the exception of the cash. All right? Now, we take this money and we're going to invest it in management and capital raise. I will show you afterwards how to deal with the capital raise because they have very big restrictions on you can't pay somebody commissions for raising money for you. You can't, unless they're licensed. And 90% of the people aren't licensed, right? So you have to be very careful how you do this and how you compensate people. So now, the next thing we do is we have what's called a waterfall. Our basic presentation to the investors, we say, okay, Mr. Investor, when you buy shares of this company, what this company is going to do for you is we're going to offer you typically a 6%, you might want to write this word down, cumulative preferred return. Cumulative preferred return. What that means is I can give you a preferred return, which means I have to pay you a 6% interest on your money, right? What happens if the economy goes down worse than where we are right now? I still have to pay you 6%, which means that I have put the project at risk because I have to pay your interest when I should have kept that money for reserves to cover the hard times. What a cumulative preferred return does for you, it gives you the ability to either pay it if the money's there or add it to the principal balance of the investor. You guys with me? So example, let's say you, Susan, invested 100 grand in this company. We're going through hard times. So I say, Susan, listen to me. The reality is we still owe you 6% on your money for this year. However, we need that money in reserves so that we're not asking you to bring us more money so that we survive or go into bankruptcy. So what we're going to do is we're going to increase our reserves account for this year. So what I'm going to do now is I owe you 100, but this year, because we're not paying you the 6% interest rate, your balance is now $106,000. You follow me? That's powerful because it gives you flexibility to move in the economy when bad things happen. And how many of you guys know that? That happens. Yeah. Right? I mean, all these people talk about how simple it is. And I am pretty sure that the reason why they do that is because they haven't done the deal themselves. All right, so the first way that I'm paying my investor is the cumulative preferred rate of return, which gives them a fixed interest rate. Then I'm going to do what's called a waterfall of distribution. How many of you guys own an LLC or a corporation? Okay. You know that there is a difference between equity of ownership and distribution of profits. You can own 90% of the company, and the distribution might be 5% of the income, right? Because of all the expenses, costs associated, or whatnot. You guys with me? So, the way we feel in a private placement like this is I'm not just giving you one asset to evaluate. You're investing in my ability to perform. So therefore, since you are at risk, and I'm only at risk with my efforts, don't you think you should be getting a larger part of the pie, right? So we're giving you a fixed 6% rate of return, but now we're giving you 70% of the net profits are calculated to be paid back to the investor. So after the 6% is paid, anything left over from there, the investor gets 70%. You guys with me? Yes. Now, that is not forever. That is while I'm paying the investor's principal down. So as I pay the principal down, when I get to a trigger where I have paid and there's still a 60% of their capital in the deal, we drop the tier to 60% distribution of profits. So now they're getting paid 6% on the remaining principal, and they're getting 60% of the net profits. Once we get to 50% of profits that we have paid the investor back, then we change the distribution to 50-50. Here's where it goes to a whole nother level. And this is why private placements in this kind of business, I feel, are powerful.